Welcome back to Scouting for Growth, the podcast where we spotlight the trailblazers, redefining the future of risk tech and impact-led innovation. Today's guest, someone who's not just shaping the insurance agenda in Europe, she's fundamentally challenging its operating model. Amélie Breitburd is the former CEO of Lloyd's Europe and a leading voice in the movement to rethink how we insure against tomorrow's biggest shocks, from climate and cyber to the long-tail risks the industry still avoids. She's a powerhouse strategist with a sharp vision that coopetition, not competition, may be the most powerful levers we have to double the size of the European insurance market and close the protection gap once and for all. Amélie doesn't just theorize, she designs models like the digital insurance exchange market, Eurodyne, advocating for new forms of syndication, capital mutualization, and public-private matchmaking that could unlock billions in new premium and reinvest that capital back into resilient economies. In today's conversation, we will unpack her journeys to Lloyd's, explore the institution's evolving role in a risk-saturated world, and dig deep in the bold idea behind her latest work. If you care about the future of insurance, inclusive innovation, or the economic imperative of protecting what matters most, this is a conversation you will want to stay tuned for. Amélie, welcome to Scouting for Growth. Amélie, thank you so much for joining me on the Scouting for Growth podcast. It's a pleasure to have you today.
Thanks. Great to be here. Thanks, Sabine, for the invitation.
Well, the pleasure is mine. And we are going to dive in, I think, a great conversation, which is going to go into where can insurance be when we look at some of the resilience we need to build in the markets and some of the new risk, emerging risk, which are affecting us today. But my first question to you, Amélie, is you've held leadership roles in some of the most iconic insurance institutions. What personal and professional experiences shape your philosophy around risk, innovation, and for sure leadership as well?
Thanks. So starting with risk, which is at the heart of what insurers do. I think a couple of comments and based on experience. Risk is about diversification, and it's obvious. I mean, that's kind of the math. One great experience, and we may talk about it later, is when AXA purchased Excel. So the portfolio was quite diverse already. And investors and analysts hated the move. I mean, it was about volatile risk, nat cat, you name it. But eventually what it was all about is AXA was very exposed to life risk, interest rates in the US, and they kind of switched. So IPO'd, sold the US life business, and then purchased Excel, which was all about nat cat and P&C. And the solvency ratio of the company increased significantly, which is counterintuitive. Yeah. And so every day people should focus on diversification and should be reminded of it. Sometimes when I see some of the syndicates who do business only in the US, actually they could do business in Europe almost for free, because from a capital perspective, diversification helps a lot. So that's one aspect on risk. Maybe a second one is, after all those conversations a bit everywhere, I've been lucky to travel and live on the European continent, in Asia, in the UK. The thing is, all risks, they're kind of all about the same aspects. Life, non-life, commercial lines, retail. It's all about whether there's going to be a risk, whether it's going to happen and how much it's going to cost. And that's quite basic as well, but that's quite helpful as well. And it shaped my thinking that we're going to discuss a bit later. Another aspect is the link with the local culture. I was talking about my travel a bit everywhere. If you go to Asia, people are very optimistic, not risk adverse. When you come back to Europe, it's all about the old Europe and, being cautious and risk adverse. And so that link to culture is essential in insurance, and which is a good segue to the question of innovation. Because what struck me, because, I fell into insurance a bit randomly. I was in an audit firm and I started to audit an insurance company. And I think, I was coming with this background around strategy and marketing and customers. And you never speak about this in an insurance company. I mean, I'm exaggerating a bit. But innovating, it's not so much about innovating because of all the other things I've said, it's a lot about math and statistics. And can you innovate around math? Not a lot. So for years, there was almost no strong innovation. Having said that, something which is really shaking the statistics at the moment, that's AI and data and AI. And this is where that's the age of innovation at last, I would say, for insurance. Now, because that's something which is really at the heart of insurance and risk, which is statistics, and it's kind of shaped with AI. And maybe the last point around leadership. I believe that leadership is around, being able to tell a story. And because, again, it was all about math, it's difficult for insurance leaders to tell a story. Well, actually, there's a great story, which is we're here to help people. Nobody would do anything. You wouldn't even, take a bike, drive a car, even, fly to Mars without an insurance. And so it's a key enabler. And so as leaders in the insurance industry, I believe we can show a great sense of purpose.
Yeah. It's interesting, the conversation we just had on leadership, because there are some brands out there, I think some of the Fortune 500, which are doing really well, I think, in marketing. And I've been privileged to work with them and probably to influence some of their marketing behavior with some of the things they've done, which they saw result from. And one of the company for sure I admire, which is Zurich, has been really, really great at employing and applying empathy in a lot of the discussion they have with their customers and with the industry to actually highlight that the product is still a product for social good. And so therefore we should not be ashamed to talk about it. But also, I think what I've seen is when you look at talent and talent retention and acquisition, some insurers are doing it better than others, partly when we have such a big talent gap today in the industry. And your point around innovation, I've been fortunate for the past 10 years to only have been working around innovation. And yes, it's not always been easy, because I think for the first 3 to 4 years, a lot of the insurers, I think, observed through the accelerator programs what was going on and what startups could do, which one could be collaborators when building things from within. I think today they have a few. We have not many. We have a few which are applying that commercialization approach and realizing that they don't need to do everything in-house. And I know as math people, we love to do everything in-house. We don't really like buying always technology. But I think more and more, we are going to see some applying that innovation lens because they need to move faster, right? They don't have a choice. They have to move faster, Amélie.
Definitely. And I think it's really about, there was this period during which companies were mainly looking at buying, and by buying, sometimes it was killing the teams. And I definitely believe we are now in the partnership area. And in this idea of make or buy, definitely it's probably not, let's not make, let's not buy, let's partner with those startups, which is great for them because then they can work for different companies and there's this diversity and people learn from each other. So I think that definitely we are living in very interesting times.
So let's go back around your background, right? what was, for me, it will be interesting to dive into transformation and really understanding what was the most transformative moment in your career as the former CEO of Lloyd Europe, right? And how did it define what you do today and some of the views you have as to what the insurance market needs to do to be better?
So I've already spoken about the purchase of Excel by AXA, and Excel had just purchased Kathleen, which was the largest Lloyd syndicate by then. And beyond diversification, I think the fact is that I had worked by then almost 30 years in insurance, and I almost discovered this environment and world of its own on large risk. And it's a completely different environment. You have lots of intermediaries and you have MGAs. You may spend 30 years in insurance not knowing what an MGA is. So it's the kind of transformative aspect of starting to get to know that environment, and that's what led me to Lloyd's. So I was in London by then, CFO of the UK for AXA. And meeting with Lloyd's people was a complete shock somehow, because you have this tension between the old Lloyd and the new world, and that's fascinating. And I said, a bit earlier that a risk is a risk, whether it's occurring and then the severity and all are the same. Having said that, to be honest, the kind of transformative aspect was that to realize that in retail, there are simple risks with complex underwriting. So people were already using 5 years ago AI and machine learning to price, for example, motor policies, while at the same time you had those very complex risks. And in the end, pricing was quite simple. It was almost a bet because there was little data, not a lot of modeling by then. And somehow then the pricing was complex. So that was this, I would say, step into a different world, which was quite transformative for me.
Yeah. So you already mentioned the word data and you mentioned the word AI. Where do you see us going when we look at data? Because insurance has a lot of data. But do we have the right data is a question mark. And so I would really love to hear your point of view. I'm sure a lot of people would love to hear your point of view around data, whether we are using it well, whether we have the right data, and how AI would play in that sphere.
So the thing is, indeed, insurers have a lot of data. The thing is, either it's a bit outdated, and in that sense, let's take motor, for example. We have 100 years of data, which is great. But at the same time, the risk is evolving because we're moving to more autonomous cars, even if they are semi-autonomous at the moment. Now we have softwares, and it's no longer the data related to how behavior, which will be important. I mean, it will still be important, but equally all the softwares and the batteries that we have in our cars. So we're going to shift to an environment where we had 100 years of data, and we're not going to throw them in the bin, but we need to build another set of data. Then we have climate, where we have more than 100 years of data, but they are kind of almost obsolete with climate change. And there's a world where there's no data at all. So I was talking about, flying to Mars, or carbon capture, for example. Yeah. We don't have data. We don't know whether when we're going to store carbon in those wells, in the North Sea, whether they're going to be leaked in 100 years. So I think data are of the essence. So when we don't have data, then we can use the computing power to do scenario modeling in a much easier and quick way. And when we have data, I think in those specialty risks, it's about how to standardize them a little bit more so that people tend to use them on a more regular basis.
So let's go back to Lloyd's. So let's go into talking about the past, the present, and what we could expect for the future. And we know that Lloyd's has been the place for specialty insurance. And, when I arrived in the UK, I'm not going to say when, but it was when I did Erasmus. I actually, after 3 years of studying, I was interviewed by Lloyd's and I work with one of their brokers. At the time, top 5 brokers in Lloyd's of London. And what is interesting is what was top 5 28 years ago is not today. And I actually was part of the corporation, and I was a regulator when the regulation was at Lloyd's. Now it's at the FCA. And so, like you said, it's for me, what was attractive, it was a marketplace, right? The way they sold it to me was, you don't need to go into banking, Sabine, you have a marketplace here. So when we look at Lloyd historically as being the place for specialty insurance and innovation, how would you describe the evolution of the institution from the coffee house to what it is today, and all the digital transformation it is trying to implement?
So I think it's great to come back to the coffee house, because for me, it's really showing that world of large risk insurance is primarily about capital. And then you have underwriting, but you need to have both at the same time. So money, basically, and expertise. And the coffee shop is really portraying that, because you had those British lords who had the capital, and you had those underwriters who were pricing the risk. So first, it's really showing, and that's something that is kind of kept in the Lloyd's market, because it's primarily a capital market and then an underwriting market. Then second, and we're going to rediscuss it, it was already by then when you wanted to insure a ship, which was going to to America and then back again, you couldn't insure it by yourself. So you need to have several British laws, so the names then insuring that, and we'll come back to it. So this co-insurance and syndication. So I think indeed already coming back to this coffee house, I think is of the essence. Then, and as you say, it was already showing this marketplace, which is the fact that there's a lot of people in that market. So you need to have insurers, brokers, underwriters, customers, and that's kind of this bubble. And I think that then, if you move to this, so also maybe a word about innovation. I like to say that innovation is definitely at Lloyd's, but most of the time when Lloyd's was quite bold in underwriting, let's say, aviation risk or cyber risk for the first time, actually it was, as I was saying, almost a bet. But the thing is, they were together in taking that bet. And so it's not really about pure innovation. It was, again, that statistical aspect, which is when you're together and then you're taking risk together, then you lower the cost of capital, and we'll come back to it. Lloyd, I think, was with Blueprint 1, so back then in 2019, really at the forefront of innovation, because it was really the idea of digitalizing the market. I think that somehow the fact that COVID was there, on the one hand, accelerated one aspect, which is the fact that they had to go digital, but it was more going to PDF rather than the way to manage risk altogether. And so I think that somehow COVID slowed down a little bit, because there was this acceleration on being virtual, the kind of virtual underwriting room that people spoke about. And it delayed a little bit the question of whether the exchange aspect could become more digital. And that's the journey today, is whether moving from paper to PDF is one thing, but can they move from an exchange perspective to more digitalized exchanges between the various parts?
Yeah, and I've seen technology being the chair for the Accord Solution Group. It's interesting to see the evolution, and how HTML has moved and how data is being transferred to actually make it easier to the market, in the market, to actually transact digitally. But there's a lot of work to do. You mentioned M&A earlier, right? And core system and the legacy debt that the industry has on the shell, let's say, needs to be dealt with as well. So given the pace of the risk we are seeing, and there's a lot of global systemic risk, we have cyber, talk about climate, geopolitical issues now affecting us all. How is Lloyd's Europe being different from Lloyd's UK? And how do they collaborate together? And I remember there is also Lloyd's, I think, in Singapore. There's Lloyd's in the United States. How do the institution collaborate?
So I think that there's a strong collaboration, but definitely the European market is a bit different. Lloyd's, there's one thing in Europe, which is you have large incumbents. And that's something which is a bit rare. I would say that, and you may have heard about the Draghi's report around Europe, where we don't have enough champions. Mm-hmm. For once in insurance and reinsurance, we have the largest companies in the world. I mean, if you set aside Pingham. So I think the fact that there are very large companies, and because also of the footprint of Lloyd's and the British Empire, somehow Europe has always been a small part of Europe. Of Lloyd's. And the thing is, and then there was Brexit, so it didn't help Lloyd's develop itself in Europe. And there's so much attraction in the US. You know, you have large tickets, the rates are higher. So there's a lot of traction for Lloyd's syndicates to go to the US. So Europe has always been a bit apart from that, and language is different, and it's very fragmented, and you have lots of different brokers. So post-Brexit as well, there was this question for European brokers of whether Lloyd's could continue to operate in Europe. So that's what sets Europe a little bit aside within the Lloyd's environment. But I think that now things are fully implemented so that the Lloyd's market can thrive in Europe.
Yeah, and so from innovation viewpoint, do you believe Lloyd's is doing enough to remain a market shaper across the globe? You know, I'm very proud of being worked for Lloyd's in my younger days. And I just remember right now a post I saw on LinkedIn from Nigel Walsh around, you know, the fact that, you know, Lloyd's is still a specialty market that we are looking for. But I also remember a conversation I had with Dame Ingebill, who said, you know, the numbers are getting smaller. So is Lloyd's still the market shaper?
I think that Lloyd's has key characteristics which are absolutely unique. So one is the portfolio of licenses, the fact that you can do insurance everywhere from London, and only usually you can do that only with reinsurance, where you have no limits in terms of cross-border barriers. So that's unique. Then there's this aspect of syndication. We'll come back to it. Mm-hmm. And the fact that there is a central fund where, you know, if one defaults, then you can go to it, and it's then providing a unique rating to Lloyd. So I think that all of this is, again, pretty unique. And this is where Lloyd's can definitely continue to thrive. I think that then, indeed, there's this question around innovation and moving probably to more of a digital pace. And what may happen is that there may be other places in the world that would then think about, you know, this unique setup and try to copy paste it. And I don't think it would be in competition with Lloyd, because then Lloyd can still participate in those places. You were mentioning Singapore. It could happen in other places. I mean, Lloyd is very active on the ENS market, but definitely that this question of whether they'll be able to innovate more. I think that there's also a bit of this question when you think about a platform. There's always a question of whether there should be many or just one. Think about LinkedIn. I think it's almost like what we call in the business of platform, the winner takes it all. Mm-hmm. Because, well, you started to be on LinkedIn. I started to be on LinkedIn. And so I think there's now 1 billion people on LinkedIn, which, if you think about the planet and you remove, you know, the grandpas and grandmas and the kids,
yes,
it's almost everybody.
Correct.
And so there's this in the business of platform, there's this idea that it's very difficult to have different, you know, several successful platforms. But I think that in insurance, because of some of the local aspects and still people. And that's something which is about those famous complex risks. The fact that because it's complex and people don't have a lot of data, then it's going to be a matter of trust. Yeah. And therefore people like to see their underwriters. And that's why I think in that area, having various platforms in the world could make sense. And that's why I think that Lloyd still has a great future.
Yeah, a great opportunity. So let's try now to redesign insurance through cooperation, which was the big topic. I listened to twice your presentation, and that's where I posed, and I thought I really need to talk to Amélie, because I think the concept you shared with us at the beginning of the year is very important for us to ponder on. And I know we are not the fastest movers, so it may take some time for acceptance, but we have seen EIOPA, thinking about very similar models. So you introduced the idea of Coopetition, right? Which is a model I learned during my business school time, so 28 years ago, as a model to double the size of our markets, right? And we need that right now. Why now?
So I think that at the moment, and we spoke about innovation, there's this idea that first, the protection gap has never been so big. It's not really that people are less insured, it's just that the value of the assets are getting bigger. And at the same time, people don't take more cover. Why? Because it's not that there's not enough supply. There's a lot of money in the world. But I think it's about the fragmentation of the supply and the fact that either people say, oh, it's too risky, I'm not going to insure it, or I'm going to insure it, but it's quite expensive. And therefore, demand is not following. So we have this large protection gap. It's costing a lot of money to states, governments, them being nationals, or in the case of Europe, EU, because EU is already paying for some of those disasters. We've seen this for Storm Boris, where the Commission paid 10 billion euros. So that's a lot when you think that there may be other priorities. The EU Commission paid for Valencia as well. So there is this protection gap. And at the same time, insurers say, well, I can't insure them. It's too costly. And also that's because in Europe, they are used to then cover one risk. They were so big, they have so large balance sheets that they could really cover one risk, which was never the case in the US. And that's why in the US, this idea of syndication, and we'll come back to it, was of the essence. So I think we are at this moment where there's a bit of a blocker. We can see that some people cannot find insurance. And at the same time, those insurance companies, who, thanks to their great balance sheet, could continue to underwrite risk. At the same time, now they are saying sometimes no. But with technology, the idea is Coopetition is instead of saying, well, I'm trying to be better than the others, because when you listen to some of those large groups and their investor days, they all say, I'm going to grow selectively. And if everybody does that, then that's the competition on those very good risks. But what about the other risk?
Absolutely.
And so Coopetition, that's the idea of saying, actually, if we were to work together as competitors, then we would access a market which is today not accessible because not affordable. And if we were to work together as insurers, then we could price the risk a bit differently, and probably I'll explain a bit more.
Yes, absolutely. So let's go back to that presentation. You talk about breaking the vicious circle of low affordability, low demand, and under-insurance. So for you, what are the most immediate levers we must pull to escape this cycle, right? Because we are still dealing with, as you said, a very traditional industry.
Yes. So what I call the vicious circle is this idea that because there's not, the prices are too high, then there's not enough demand. And because there's not enough demand, people are not insured. They are not insured, so they don't really care, in the sense that usually insurance brings prevention. When you're insured, then you're going to, if you think about fire or the weather, then or thieves, then you're going to have more, robust doors and windows, etc. So, And because there's no prevention, then there's more losses. So that's this vicious circle. How to find the spark which will invert that circle? And this is where, if insurers were together in proposing to cover not one risk by themselves. So let's say that we have this quantity of risk that we're going to call R. Instead of insuring R, one insurer is insuring all that big piece. If instead we have 10 insurers, each of them insuring 10% of that piece, and then each insurer insuring 10% of that one, 10% of another one. So insuring still the same quantity of risk, but 10 different risks, then in terms of Solvency II capital requirement, then it's going to be lower. And that's the idea that then if we were to look at some of those risks by sharing risk together, then we're going to lower the cost of capital. And this is that spark that the market needs, because if you lower the cost of capital, then it's less expensive. Then people are going to buy it. Then there's the idea of having a platform, we may discuss it, which is going to increase access. So it's not only that it's going to be less expensive, but people will know, oh, I can go there to find some risk, because sometimes SMEs, for example, can't find a place. They don't know where to go to find a broker. So lower prices, then more demand. And with more demand, you have more prevention. If you have more prevention, then the cost of those premiums is going to be lower as well. And then it's going to bring more people to the market. And there's also a volume aspect, like any other goods. When you're selling more, then the prices are going down. And also then with more private cover, so less government money. And with less government money, you also have then better budgets. Then probably those governments may also invest more in infrastructure, which could be either for cyber or climate. It's going to bring prices down as well. So that's the virtuous circle. So some people would say, oh, but then maybe those SMEs or corporates, they don't have a lot of money. Actually, also because then we're going to have all of that money collected by insurance companies, then they're going to be able to invest more in the economy. So it's almost like a give back to society. By collecting more premium, they're going to invest more, and therefore those companies will develop themselves as well. So that's the virtuous circle.
Yeah. So recently, actually, Amélie, I wrote an article. I was having a workshop for my team around how to build scenarios and use the scenario planning approach to actually start looking at where we are going to be in 10 to 15 years from now. And, when I used to run those workshops with corporates, when you used to go 10 to 15 years, they used to look at you like the eyes rolling. And I said to the coach, I said, maybe we should go for 5 years. I said, well, 5 years is not scenario planning. Anyhow, after that, I decided to go and play a little bit with scenarios. And I said, okay, where is insurance going to go? With the help of a little bit of ChatGPT. And I came up with those 4 scenarios, which is looking at, the company being internally focused or market driven, then fragmented or integrated. And then it was interesting because I would not say each scenario are mutually exclusive. We are going through a period of protectionism, but there is an opportunity for us to avoid the collapse, what we call the collapse economy, which is market driven and being very fragmented. The opportunity for us is going to be to move away from protectionism and to be much more integrated. So to allow for that collaboration, which probably will go into the discussion around syndication. And the last one, the nirvana, is being able to do risk as a service. So my question to you, so let's talk syndication. First, let's just explain what syndication is for those who do not know the term. And then let's go into how could it dramatically lower the cost of capital.
So syndication is what we call co-insurance. It's the fact that already from the start, you're going to share a policy between several insurers. So that's co-insurance. And the word syndication is equally used. The thing is, an insurer has a choice. Either, so they can take one risk by themselves, they can share, and then that's co-insurance. And if they take the risk by themselves, then they could do reinsurance. And also they could go to the ILS market, the insurance-linked security market, to also offload some of the risk of their balance sheet. So there's this choice. I think the reason why I'm putting a bit more emphasis on co-insurance at the start rather than reinsurance or ILS, even though I still believe that they are very important and I'm going to go to it, is that if we want to explore that part of the market which is not insured today, and if you're sitting at a board, for example, you're doing today a certain level of cyber risk, and you say, I'm going to double it, it's unlikely that the board is going to say yes. And that's why, and it could have been the solution, like, I'm going to double my cyber underwriting, and then I'm going to do reinsurance. But the issue is because boards are so, concerned and they have a low risk appetite, it's difficult to double your risk appetite. And therefore, syndication would allow you to do maybe only 10% more first, because you're going to take 10% of each of the new policy rather than 100% and then reinsurance. And that's why I think that it's quite powerful. To be honest, we could do a bit of both, so a bit of co-insurance. And on the reinsurance side, we could also use ILS. But if you think about ILS, it's also, again, about syndication, but because when you issue an ILS, like a cat bond, you need to find several investors. So it's the same. Then you're going to diversify the number of people who are going to then take some of your risk. The nice thing about those cat bonds is that you can have coming to the market people who are not insurers. So but you could do this for co-insurance as well, because from the start, you could say, I'm going to offer an entry to the insurance market to people who are not underwriting those types of risks today. So the idea of building a European platform to do more syndication, so co-insurance, is to say, well, we have the incumbents. They are likely to still be what we call the leaders, because, you have lead and followers in co-insurance. But then you could also attract, from the start of the underwriting at inception of the policy, for example, bank assurers. So we have in Europe very powerful bank assurers. Sometimes, most of the time, they do retail risk, not a lot of commercial risk. And their board would be reluctant to suddenly do cyber risk. But if you offer them a platform where they can take 2% here, 3% there, then maybe those bank assurers are going to be willing to start underwriting that business, rather than taking 100% of a given risk and then counting on reinsurance. So this is where, and you could do that with bank assurers, you could do that with some of the mutual companies, very local, who today as well are not in the specialty market. But by offering the option to then underwrite just a bit of that policy and a small piece of that policy, then you're going to allow them to enter that market that they wouldn't have entered. But equally, to be honest, you could have then a company doing 100%, taking 100% of risk, and then having cat bonds helping, and then those same bank assurers or mutual companies could take a portion of that cat bond as well. So there's, and the idea of creating a syndication market, and that's why I talk more about syndication than co-insurance, because it could be either co-insurance of insurance policies or a platform where you're going to go with your cat bond and find different investors.
Yeah.
And then you have, of course, people who are not even in insurance, like pension funds and private equity and family business. So this is where the syndication market could be open for insurance or cat bonds, and then offering multiple choices for insurance companies to take more risk, either directly at inception or afterwards, once the risk is underwritten. If you look at Beazley, for example, Beazley has been underwriting a lot of cyber risk, and they've issued more cat bonds on cyber than other companies. And the ILS market used to be more for climate risk, and now it's shifting to other risks such as cyber. thanks to players like Beazley, for example.
Yeah. So as I'm listening to you, Amélie, it just reminds me my world of VC, actually. Because when you think about how VC operate, they actually take a small share of a startup, right? Or a big organization, which sometimes become unicorns. And, we've seen that progression towards CVC, corporate venture capitalists. So they didn't exist. We only had VC, then we had corporate VC, and now we have corporate VC working with VCs, right? And I was sitting in one of the boards with a VC group where I'm an advisor. And I remember we were talking about cyber, and that was 2 years ago. And one of the statements during that board is the only way we can insure cyber is by going to the ILS and actually looking at private equity and family offices, because the market of insurance is too small to cover all that risk. So let's talk now about the Euro DIEM, per diem, which is a digital insurance exchange market. And I think it's probably a bold proposal. Is this a blueprint for European Lloyd's 2.0 or something even more radical? Amélie.
So definitely there's this idea of a syndication market very close to the way Lloyd's is working. It's not in competition with Lloyd, because Lloyd's Europe would be more than welcome to participate, because in this idea of syndication, the more the merrier. So what are the similar features and the differences? I think in terms of differences, first, there's this idea that there's the geography. So as I said, Europe is small within Lloyd's, and here it would be really dedicated to the European market. If you think about 27 countries, and in our jargon in Europe, we have EU and we have also EFTA, where you have Switzerland, notably, and Norway. So I would think about something which is EU plus those countries. So let's say 30 countries. So one of the differences would be the geography. Then also the types of risk and the types of customers, so much more SMEs as well.
Yeah.
So those are some of the differences. And the other aspect is that this search for a lot of, let's say, numerous carriers, several carriers per policies or per ILS, the difference would be that it would be digitalized. And by that, I mean that you're a carrier, then you're entering your risk, and then your risk appetite. And there may be 300 companies on that market, because that's the size of the market. And as I said, we would encourage bancassurers and mutual companies to come as well, so not only the incumbents. Mm-hmm. So let's say tens of companies entering their risk appetite, and then the customer, with the support of their broker, would enter a description of their risk, and there would be a pre-matching of that risk with the risk appetite of the companies. And then the broker would, thanks to this acceleration of the syndication, because it would be really easier to find 10, 20, sometimes 30 insurers for a given insurance policy, then the brokers would finalize the program. So it's not like Amazon, it's not click and go and pay, but the first step is more digitalized, and it's a matchmaking platform. That's what would be much more digital. I think that if you compare to 5 years ago, one aspect is that previously some of those risks, you were having tons of PDFs and Word documents and Excel sheets, and I think one of the big game changer are those companies, more software as a service, doing ingestion, and therefore they can digest all those documents on behalf of the customers and the brokers, and present it in a much more standardized way. So even though those risks are still quite bespoke, there is a much more easier way to standardize risk today than 5 years ago. And because of this, then you can have much more complex risks still being at least a little bit better described in a standardized way than 10 years ago. And risk appetite is the same. Companies, thanks to, that's the same AI, So they can describe their risk appetite, not only with the limits and the tranches and the type of businesses that they want to underwrite and all of this, but they can also start to input in the algorithm some other aspects which used to be more difficult to standardize. And therefore, then you can have this matching that you couldn't have a few years ago. And that's the key difference. And that's this accelerator and industrialization of co-insurance. And again, it could be for insurance or it could be for ILS looking for investors. That's the game changer. I'll add two things. One is that we are talking about data. Then people can share data on that platform. It would be fully anonymized. Mm-hmm. And then you can have a view on claims and therefore have access to claims which would be sorted out, by type of claims. And this is what happened for cyber, for example, in the US. And then you can create, indices. So that's part of the virtuous circle because we would have more data. And at the end of the day, it should lower the cost of the premium.
So what does that mean? Does that fundamentally change underwriting principle and approaches and the way the capital flows?
I think that it's going to change underwriting because of there'll be more data. So it's going to be a bit less of a bet.
Yeah, okay.
I think going forward, and it's going to ease capital flowing because the capital providers will have this option to build a portfolio of risk much more diversified.
Yeah.
Because for them it's going to be industrialized as well what they can take, and they could take, as I said, a little bit of cyber, a little bit of this, because it's a marketplace. There'll be an availability of options for them to build a very diversified portfolio in a much easier way than today. If they want to invest, then they need to, invest in syndicates or, so this idea of a platform is going to accelerate that aspect.
So I believe just a few days ago that the US and following the LA wildfire are looking at public-private matchmaking. So I'd love for you to explain what this is and how that plays into a multi-layered risk mutualization aspects as well.
So, as I said, I believe that thanks to this, we're going to solve part of the protection gap, so increase the size of the risk which are covered. So the private market, and I believe that it could be, at least in Europe, almost doubling the size of the market covered by the private sector. So it's good for governments and the European Commission, who should pay less. But if you think about that kind of platform, at the end of the day, it's going to be a great way for those governments and supranationals, EU, to understand exactly where should be what we call their attachment point, the moment at which they're going to pay. So what we could imagine is that at the end of the day, on that platform, you would have the private market backed by public and private partnership. It could be reinsurance schemes, so pooling the risk in reinsurance, but after people would have done more syndication at the start, and you could have a government backstop at some point. And you mentioned EIOPA and the European Central Bank. They've written that paper in December 2024, proposing two pillars to do this reinsurance, private and public reinsurance scheme, plus a European backstop that they call a disaster fund. And the moment you think about professionalizing a little bit more this process that already exists but needs to be better shaped and more industrialized, because at the moment, the way a European Commission is working on this is, there's a disaster and there's a decision ex post to pay.
Yeah.
So there needs to be, and then they're looking at funds. So it needs to be, I would say, industrialized a little bit more so that countries know how much they contribute. So there needs to be an entity thinking about this and making this happen. If there's a reinsurance scheme, there needs to be, again, an entity a little bit like what we have in France, which is Caisse Centrale de Réassurance. So with people and operational design and processes. So if you think that it's going to happen, then this idea of having all of this called this EuroDiem, digital insurance exchange market, you can have the private sector part as part of this platform. And this is somehow a platform then with 3 pillars, the 2 pillars proposed by ECB and EIOPA, and this private market pillar, where there would be this exchange market all in one.
Yeah. You mentioned, I did my internship before coming to the UK to la Caisse des dépôts et consignations, swap and Black-Scholes model. So listening to you is like, it got me back to those times. So when we start looking at regulation in Europe, can actually the regulator align amongst each other? Can they actually support easily this type of initiative?
I think that somehow, so there is a bit of regulation. As I said, that they need to probably write a bit more how this could work, the PPP aspect. But it's probably less around regulation than around signaling on, this is a good idea. And what we have at the moment in Europe, we have a lot of discussions on capital market union. So this idea that we should merge the capital markets in Europe because, you have one in Germany, one in Belgium, one in Italy, one in France. Even though some of them are grouped under Euronext, it's not like the US. So they are not deep and liquid, and there's a lot of discussions around that and how to have, retail money being invested and increase the investment. So I believe that EuroDiem could be part of this capital market union that we now call as well savings and investment union initiative, because it's, as I said, it's also about collecting money here from SMEs and corporate and invest it into the overall economy. It's participating into the overall better financial protection of citizens and businesses who would be better covered. And at the end of the day, so it could be a bit of a digital infrastructure. So signaling that it would make sense to do this. Then there's always, but Europe is always very slow. And on the other hand, we can see, for example, on defense, that if something happens, then suddenly people change their mind and they can be very quick. So I think it's probably both about European Commission signaling that they may move to a PPP, that they may indeed increase a little bit, let's say, strengthen a little bit those processes that are already in place, and have then the ecosystem in Europe, so European insurance companies, as I said, including mutuals and bancassurers and brokers, working together on building that platform. Having said that, I would not recommend that this is managed and built by insurers. Mm-hmm. It could be any other type of financial institutions. If you think about Euroclear or Euronext, those are private companies who are trusted companies. If you think about the European cloud or the fraud aspect of the cybersecurity, those could be companies who would be then building that platform on which all the European companies, but that could be, subsidiaries from elsewhere, and brokers and customers, all of them operating on that platform.
So actually, you're already talking about the collaboration, not just, regulators, ILS market, and we talked about government initiatives, but it's about also including the brokers, the reinsurers, all the different parties we have talked about, as well as the tech platform providers. So what incentives would they have to actually accept that?
So I think that the what we have to see is that it's not eating anybody's lunch, in the sense that we are talking about that part of the market which is not covered. So it's not doing things differently for what is covered today. Mm-hmm. It's really thanks to this Coopetition and working together on insuring risk together. It's opening a new market. And I think that it could be as big as 200 billion euros of premium. And so for brokers, it's new commissions. For insurance companies, it's new premium. For reinsurers, it's new premium. So it's really about doubling the size of the market and entering into a market which is at the moment not open somehow. And ECB and EIOPA speak about a market failure somehow. So because it's a brand new market, I think that the incentive for them is to have access to this market, that if they try to go there by their own, they are not going to be able to insure those policies. If you look at the last 3 years in terms of growth on the commercial lines, it was significant, but it was mainly rates and inflation. Of course, there was still a bit of new business, but not so much. So here it's really about opening growth opportunities for everybody. I think that nobody would have a downsize of any kind in that market. And so it's win-win.
Yeah. So we talked a bit about scenario planning. So let's move forward into 10 years from now. What is the one metric, market behavior, or ecosystem shifts that would prove to be the most valuable when you start looking at cooperation models we talked about? And what is the risk if we don't act now?
Well, I think that really, I've mentioned a lot the protection gap and the size of the market. For me, it's really to show that people are better insured for the future, and that there's less also government's money poured into this. Government has a lot of other stuff to be done. Maybe something as well to highlight that I would see, I mean, we mentioned cyber and climate risk. We could have, for example, long-term care as well being dealt with this, another area where there's not a lot of data. So for me, the key indicator is the protection gap has significantly reduced. And what's the risk if we don't act now? I think that the risk is what I call shrink into greatness for insurance companies, because there's no other way for me than this Coopetition to continue to grow for insurance companies. Otherwise, they're going to withdraw. I mean, you are talking about the wildfires. They're going to withdraw from lines of businesses, from geographies, and at the end of the day, we will all lose. And I started by speaking about diversification. It's about mutualization. And mutualization is the mathematic word for this. But to be honest, the more social and political word for all of this is solidarity. Mm-hmm. So I think that Coopetition is leading to solidarity. And you're talking as well about empathy. That's what it's all about.
Yeah. Comme les Français. Solidaire. Well, thank you, Amélie, very much for joining me on the Scouting for Growth podcast. I love the statement, shrinking into greatness. You know, just last week, I heard about too big to fail. We used to use that into banking. I heard it in terms of insurance. So let's see. Thank you so much for joining me.
Thank you, Sabine.
I hope you enjoyed this episode of Scouting for Growth. Please subscribe, share with friends, and leave a 5-star rating. Your rating is so valuable. I review all of them, and my team help me adapt content to meet your needs. Also, connect with me on my preferred channels. I am a B2B growth expert, so you will find me on LinkedIn, Instagram, and Threads, and X as well as Blue Sky. All information available below. Until next, keep scouting for growth.